Welcome to Homebuying 101. Buying a home is a significant and exciting step in your life, but it can also be a complex process. Here's a brief introduction to the home buying process to help you get started. So, how do you know if you are ready to purchase a home? Are you financially ready? Well, we're going to review the following items, such as checking your credit to ensure your credit scores are where we need them to be for the program you're applying for. We're also going to be checking your income to ensure stability and that you earn sufficient income to qualify for the amount of mortgage that you're interested in borrowing. We will then check your assets because we want to make sure that if you don't have enough assets for down payment and closing costs, that we find a down payment assistance program to assist you. After that, we're going to check different mortgage products for you to ensure that you're being put in the correct mortgage program. Once we have pre-approved you, you then want to hire your real estate agent who will find the home of your dreams. That realtor will make an offer on your behalf and they will prepare the contract or real estate binder depending upon the state that you're purchasing in. In some states, the attorney will prepare the contract and the real estate agent simply prepares a binder. We then have the earnest money. So remember, that's anywhere between 1 and 5% of your purchase price that you have to put down on title or down with title or the seller's attorney, again, depending upon the state that you're purchasing in. Your realtor is also going to order that home inspection report for you to ensure that the property that you're purchasing is structurally sound. In addition, during the process of applying for a mortgage, you want to shop homeowners insurance as soon as you apply, and you need to get the mortgage lender a copy of that insurance quote to ensure that you're still going to qualify on your mortgage payment. Should that homeowner's insurance be slightly higher, or should there be additional insurance required, such as flood insurance? So always ask your realtor, is the home in a flood zone? We're also going to ensure that title has been ordered. Generally speaking, your listing agent will order the title insurance, and some of the title fees may be paid by the seller. Please confirm with your local state regulations to see who is who is responsible for paying what fees with your title. In other states, your attorney is going to order that title report, and you may be responsible for all title fees. So again, every state is a little bit different. We're also going to make sure that your appraisal is ordered the second that you have signed all of your disclosures and your intent to proceed. We need to ensure that your property is worth what you are purchasing it for. In some cases, if the appraisal does not come in for the sales price, you may reject purchasing the property and get out of the deal and receive a refund of your down payment. In other cases, if you're in a hot market, you may have to actually pay what we call a gap. That would be a gap between what the sales price is and what the actual appraised value is to make everything whole. Now, there's a lot of different programs to choose from. We have conventional, that's Fannie Mae and Freddie Mac. And conventional is used for 1 to 4 family, primary homes, second homes, and investment properties. And on primary homes, you can put as little as 3% down. You will need a minimum FICO score of 620. Some lenders do have overlays and may require a slightly higher credit score, and some down payment assistance programs also may require a slightly higher credit score. Then we have the FHA, that's your Federal Housing Administration. And the FHA is specifically for primary properties only. It can be a 1 to 4 family, but as a borrower, you must occupy one of the units. You may put down as little as 3.5%, and you can have a 580 credit score and still be able to get approved. In some cases, if you have a lower credit score and you have compensating factors, we can do what we call a manual underwrite and still approve the FHA loan. We then have the USDA. That's the U.S. Department of Agriculture, and that is a zero money down loan. It's specifically for rural properties, and it is only for primary residents. Now, there are household income limits that do apply to this program, and generally speaking, they want to see your credit score around 640. We then have the VA loan. And the VA loan is specifically for our enlisted soldiers, our veterans, and reservists, provided that they have sufficient points. It is a 0% down loan. It is for primary residents only. However, you do get a second entitlement as a veteran, where you can actually purchase a second primary home should you decide to upgrade from the original home that you purchased, or should you be transferred to another state. We also finally have what we call non-qualified mortgages, non-QM loans. Whoops, let's go back. And those non-QM loans fill in for all the different things that will not be able to go under the other programs that we just went over. So non-qualified loans is where you'll get your bank statement loans for people that are self-employed and have lots of large deposits from their business, but they don't really have a lot of income showing on their tax returns. It's also for people that have lower credit scores that can't qualify for our traditional programs. It's also for investors who want to purchase properties in an LLC. And it is also for those difficult properties, such as non-warrantable condos. Generally speaking, you will have to put 20% down when you qualify for a non-QM program. However, there are some investors out there that will take as little as 10% down should you have excellent credit and compensating factors, such as additional money in reserves in case of a problem with making the reserves are usually there in case you lose your job and you need to like live on the money to pay the mortgage. So that's kind of like what reserves are. So what money are you going to need? Well, you need that earnest money. That's 1 to 5% of the purchase price. And then you're going to need additional money to pay for the home inspection and termite inspection if it's required in the state that you're purchasing in. You may also have to purchase a survey in some states, and then in other states, you may also have to hire your own real estate attorney. So you're going to need to make sure that you have enough money to cover these 5 items. Now, again, you need down payment. It can be in the form of a gift or down payment assistance program, but generally you're looking at 3 to 20% down depending upon the mortgage program that you are applying for. Closing costs are generally 2 to 4% of the purchase price, again, depending upon the state that you are purchasing in. You also have to purchase a homeowner's insurance policy and pay for that in full for the year. In addition, the lender will take 3 months of those payments and put them into an escrow account, along with 3 to 6 months of monthly payments of your property taxes. They do that to ensure that taxes and insurance are always paid on time. If the lender is ever late, they have to pay all the fees, all the late fees, if they don't get them premiums paid on time. You do have certain programs with conventional where you can do an escrow waiver, but generally speaking, USDA, VA, and FHA do require escrow accounts to be set up. Most non-QM products do not require escrow accounts, and some conventional loans, depending upon the loan to value, will also waive those escrows. However, be very careful because if you are waiving escrows, you may be subject to a slightly higher interest rate because you have made the loan slightly riskier. So you can get a gift to cover the down payment and all of the closing costs. That gift can come from a relative, fiance, non-occupying, or a non-borrowing spouse. Some lenders are a little more strict with friends and cousins giving gifts, but I've been doing this for a long time, and there is always a way to work that into the scenario because sometimes friends are more brothers and sisters than our own families. So we do understand that, and generally, it's fine conventionally, and VA, sometimes the FHA may give a little bit of a pushback. And of course, if you do not have enough money for the down payment and closing costs, we can always look to see what down payment assistance programs that you may qualify for. Again, if you already have money saved for the down payment, you will not be able to qualify for a down payment assistance program. Now, we use a lot of lingo in the industry, but the one that you need to know the most is PITI. That's your principal, interest, taxes, and insurance. So here's a breakdown of kind of what it would be. You got 1,500 in principal, 1,500 in interest. Your monthly taxes are 300, and your monthly insurances are 250. That's going to add up to a total monthly payment of 3,250. Now, remember, we have rules in the industry, and one of the big rules is the rule of two. You will need 2 years of federal tax returns and business returns if you are self-employed. You will also need 2 years of W-2s or 1099s. In addition to that, we need to cover a 2-year job history as well as residence history. And we will need to collect 2 months bank statements. The bank statements need to be complete. Any numbered page needs to be supplied. So what is a good credit score? Well, traditionally speaking, 750 and above is considered absolutely excellent. Personally, I feel that if you have 720 and above, it's still excellent. But this is just how they're rating it with their algorithms. So between 700 and 749, it's good. And then as you can see, fair is kind of 650 to 699. Poor is under 550 to 649. And then bad credit, which most likely would not be able to be mortgageable, would be between 350 and 549. If you do have a low FICO score, a non-QM lender may be your best bet. And remember, the higher your credit score, the lower that interest rate. Now, there's also another thing called mortgage insurance. And mortgage insurance is for the lender, and it protects the lender in case a borrower defaults on their mortgage. So if they are putting less than 20% down, you will be subject to private mortgage insurance. That mortgage insurance can be paid monthly by the borrower. It can be paid partially by the borrower and maybe partially by the seller. It can be paid all upfront by a seller credit if you choose. And with the VA, if you are not exempt from the funding fee, you will pay on average 2.15%, which will be added into your mortgage and spread out over the term of the loan. The FHA has two premiums. They have an upfront premium called mortgage insurance premium. That's 1.75%, and that is financed into your loan. And then they also have a monthly mortgage insurance premium, and generally that would be about 0.55% of your loan amount divided by 12. And if you put at least 5% down, that fee will be dropped after 11 years. If you put less than 5% down, you will pay that monthly MIP for the life of the loan. And remember, mortgage insurance is an insurance policy that protects the mortgage lender in case of a default on the loan. This is not to be confused with flood insurance, homeowners insurance, which is also called hazard insurance. So we're almost there. There's going to be 3 different things that happen when you submit an offer. One, the offer is going to be accepted as is, and both parties, you and the sellers, We'll sign the contracts and boom, you're fully in contract. Then again, there may be a counter proposal because, well, the seller likes most of your offer, but there's a few changes that they want to make. So they will make those changes and then they will send back to you the counter offer. And then sadly, there is the offer rejected. And this just simply means that the seller is declining your offer and they're going to be going with another offer. But that's not going to happen to you because your offer is going to be accepted. And we're going to say, congratulations to you. You are under contract. So don't forget, we got a few things we got to do once you're under contract. Number one, you got to put down that earnest money, and that's going to be 1 to 5% of the purchase price. Number two, you need to make sure you schedule that home inspection in a timely manner. That home inspection is very important, and it's usually time sensitive, so you want to get that done right away. You're going to call me and you're going to start that mortgage process. And I'm going to get all your disclosures sent to you. And once you sign those disclosures, we're going to send your loan to the processor to review and submit to underwriting for approval. During this time, I want you to be shopping for that homeowner's insurance and get us that quote ASAP. Once we've done all of that, you will be clear to close and you can schedule to close on your new home. Now, just an afterthought, we want to make sure that you understand that you're going to be receiving a lot of loan disclosures in the beginning and in the end. So, in the beginning, when you get those disclosures, you need to review everything before you sign it. Never sign blindly. You have a loan estimate, and that's going to itemize all fees charged to you. You're going to have an intent to proceed. If you don't sign that intent to proceed, we cannot process your mortgage application or approve it in underwriting. You need to confirm if your rate has been locked or floating. You need to have a good communication with your loan originator to ensure that that rate is locked at an appropriate time. And at closing, you will be sent what we call a closing disclosure. And you always want to compare that closing disclosure to your initial loan estimate to see what changes were made. It's always very important to contact your loan originator and review these documents with your originator. I hope this has been helpful for you. And should you have any questions, please feel free to call me anytime. Have a wonderful day.